She's a licensed certified public accountant. She has her master's and MBA from here at Valparaiso University and her BA from Calumet College of St. Joseph. So she's held a variety of positions in manufacturing retail, as well as being the vice president and CFO for an engineering company. So we really, Susan, thanks for it. She's at a conference right now in Charleston, South Carolina. So we really thank her for taking the time to be with us. I have really enjoyed Susan's work here at Valpo. She, what was it, Susan? Last year or the year before, you did a series of presentations at campus on finance and how to ask the right questions, and it was just great. And that's one of the reasons we asked her to join us today. So, Susan, I am now going to make you, we are recording this, I am now going to make you, once I can find you on the list here, the host. And yes, and Susan, you should see this flip over now to you as the host, and on you go. And I would suggest we might want to try the raise a hand section, but Susan will also pause periodically for questions.
Yeah, I absolutely will, and encourage questions along the way. Hopefully this will be more of a conversation than a presentation. I'm going to share my screen, maybe. We'll see this. Although I want to be in the room with whomever has the fireplace. That sounds like the best place.
Bobby.
Bobby.
We're jealous.
That looked great. Okay, let's see. No, that's not the one I want. Well, we're just going to go like this.
There you go.
We're going to start from the beginning. How's that?
Perfect.
All right. Okay. Well, thank you for the great introduction, Tom. That was very kind of you. I've enjoyed working with Tom as well, as we've tried to, as we have brought up the aviation program at Valpo. It's just been a great experience. Never a dull moment in higher ed, as we all know. But thanks for the invitation. I'm going to try not to bore you. I'm going to try to lift things up in terms of financial perspective in higher ed. Even got some new stuff in here related to the House bill that's being proposed, and which is ever changing, we know, and we don't know what that'll end up looking like, but there's certainly a lot of buzz out there about that bill today. So again, here's just an overview of the topics I'd like to just share with you. Again, a top-level financial statement review, just some things to know, some things to watch. I've tried to color-code it, so when you see the red verbiage, you know that that's something to pay attention to. Then we'll talk through some external reporting considerations, as well as some financial measures. You've got a great book. Tom and I learned that we both use the same book when we teach. So the textbook that he has recommended to you, or maybe you've already read, is one I've also used. There's lots of great information there as well. And then again, we'll talk about some potential tax reform implications. This is one of my favorite quotes. I often get the question, you know, why have you stayed in higher ed for 20 years, right? And as Tom said, I previously worked outside of higher ed in private industry in the East Chicago-Hammond area here in Northwest Indiana and Chicago. And I just feel like my life was forever changed when I stepped foot on the campus. I'll just read this quote because I think it probably applies to many of you as well. The nonprofit institution neither supplies goods or services nor controls. Its product is neither a pair of shoes nor an effective regulation. Its product is a changed human being. The nonprofit institutions are human change agents. Their product is a cured patient, a child that learns, a young man or woman grown into a self-respecting adult, a changed human life altogether. So I just love this quote and just wanted to kind of start the presentation because everything revolves around our students, as we know. To set a little background for you in terms of higher ed, you may or may not be familiar with Moody's Investor Services. They are an organization that rates higher ed and other organizations in terms of their credit worthiness. So when we go to market to borrow money to build buildings or primarily to build buildings, we have to go to Moody's if we choose to have rated debt to get that credit rating. every year they issue a sector outlook. This year's higher education sector outlook, which is almost a year old now, is stable. After a couple years of sort of a negative outlook, it's stable, but it's been described as bifurcated, and that's because there's a tale of two situations here. The first being those colleges and universities with strong brands or value propositions. Moody sees them as being very stable going forward based on growing tuition revenues. The other piece of that, though, the flip side is the smaller regional institutions that are expected to encounter more difficulty. And we'll talk about that a little bit more. This is primarily related to the demographics of number of high school students that are expected to come into the pipeline over the next decade, which has fallen. So we'll talk about that a little bit more. They did have a miss on endowment investment returns. They not only look at our tuition and fees, income, expenses, they also look at our endowment in terms of size as well as investment returns. There had been a couple of years that were relatively down. And this year, the early reports are that as of June 30th, most endowments or average endowments were sitting at about 12.5% return. So that's a wonderful return for this past fiscal year. For Moody's, their A rating is the best, and they always attach either a stable or negative outlook to their rating. So you can have an A rating but a negative outlook, which is just sort of well, we have a few concerns. We think you're very creditworthy, but we need to watch a couple of things. Or it could be A stable. The rating is important as you go into the market to try to borrow money so that you can get the very best rates you can. So again, just like when we have our credit ratings, we go to borrow money for a bank or a house, that credit rating will impact the type of interest rates we can get. So new, red piece, in terms of Moody's and their negative or credit negative situations, what we're seeing right now is that the House bill in its current state is likely to be credit negative for higher education institutions. And again, we'll talk through that a little bit, but something to really stay tuned and watch over the coming weeks and months. So we're going to start out with a nonprofit financial statement high-level overview. Simply stated, broad terms. I'm going to try not to get into the weeds. If I start to, you can call me out on that. So in a typical set of financial statements, we start with a statement of a financial position, and this is also known in private industry or a for-profit organization as a balance sheet. So these are the things you owe, the things you own. It's a snapshot at a point in time. For example, the balance sheet would be dated June 30th, 2017, and that's a snapshot of all the balances in your cash and your endowments, everything you owe to the bank at that point in time. When you flip through a set of financial statements, in particular an audited statement, there will be an auditor's opinion regarding the statements. And what I'd like to point out here when we talk about auditors and audited statements is they won't necessarily detect cases of fraud. Their opinion is strictly in regards to the statements themselves and whether or not they accurately reflect your financial position. So they're not there to necessarily flesh out fraud, although they can do that in the course of their work, but just an important distinction. They're typically presented with 2 years of information, so you can see your comparison over time. The simple formula is, this is simple accounting, assets minus liabilities equal net assets. And then that bottom bullet point, the net assets actually have 3 buckets, the unrestricted, temporarily restricted, and permanently restricted net assets. And we're going to drill down into that a little bit more in just a couple of slides. So that's a high-level overview of what a balance sheet or a statement of financial position is. So this one gets busy because I'm going to start to introduce color, and I probably should have put some animation on this. But let's start on the left-hand side and talk about assets. Cash is king. If you read your book, the authors bring that out, and I always remind my students definitely when organizations of any type go under, it's typically because they run out of cash. So important to remember that. Cash in higher ed is very cyclical, at least for us it is at Valpo. And what I mean by that is you might gather the beginning of each semester, usually we're more flush with cash than we are towards the end of the semester. And that's because students are making those payments on their tuition bills before they arrive to campus, unless they're paying over the semester. The investments, you see that the investments in property, plant, and equipment are in red. And that's because that's typically the bulk of assets, particularly for a private institution, when we're talking about endowment and we're talking about that physical infrastructure. So again, this would be for a traditional campus where you've got residence halls, you've got academic buildings, and so forth. The investment balance would, of course, be market driven. We should have some really high balances at this point due to the market performance over the last year, where there have been years where that, of course, that's not been the case. When you think about 2008, 2009, and the market crash, those endowment values plummeted some as much as 30 to 40%. It was an interesting time. The other piece usually on the asset side are what is owed to the institution from students or perhaps even from pledges. And I've got fundraising campaign question mark. So if you're in the middle of a campaign and getting lots of pledges in, that balance will rise, and that's okay. And it's okay that that those rise as long as they pay them off certainly over time. On the liabilities, let's stay at the top there. So what you need to watch for in terms of assets, any decreasing balances where there's not really a good explanation as to why. So, you know, a lot of this is common sense. Again, if you're in a down market, your endowment value is going to go down. Up market's going to go up. So those things make sense. But if you've got things that are balances that are counterintuitive, that don't ring true to what you know is going on in the marketplace, those are likely areas that you need to kind of follow up on and ask questions about. In terms of on the liability side, primarily comprised, again, private higher ed notes and bonds payable. This is financing of typically your physical plant. And then depending on whether you're building a building, your accounts payable or constructions payable might be large over time. Pension and healthcare liabilities, again, depending on your own institution, whether or not you even offer this to your retirees. I think for the most part, many of my colleagues in private higher ed have the 403B plan, which is the defined contribution plan rather than a defined benefit plan, and won't have those pension liabilities on the balance sheet. And then there's just a little note about asbestos liability. So I'd say about 10 years ago, the accounting rules were changed so that you had to actually put something on a liability in your balance sheet for those asbestos liabilities that you might have in those old buildings. So that's just another thing to watch as those older buildings are taken out of service or as they are remediated, those types of balances come down. So opposite of assets, on the liability side, watch increasing balances without a good explanation as to why. So if your pension and healthcare liabilities are rising, it's really good to have a handle on the reasons for that. Same thing for all of those categories there. Okay, we're still on the same, statement, part of the statement.
Uh-oh.
To understand, because you don't see this outside of in a for-profit corporation. So those net assets are divided between unrestricted, temporarily restricted, and permanently restricted net assets. And they really are very self-descriptive, but what I tried to do was include here some examples of what's included. So in terms of unrestricted net assets, that's what they are. They're not restricted by any donor restriction. They represent typically the retained earnings over time of the institution. And again, unrestricted as to purpose. Temporarily restricted are restricted for a period of time. They're typically restricted by either your board or a donor. or by action or time. So some of this is related to, a really good example here I like to give is gifts given to build a new facility live in this temporarily restricted budget. So they're temporarily restricted until that project is completed, at which time it moves onto the into your equipment line or your property line item. Endowment earnings are also in temporarily restricted net assets, as opposed to the permanently restricted piece, which represents those original gifts. So if I gave $100,000 to the endowment, that lives in that permanently restricted classification. Any earnings over and above that actually live in that temporarily restricted classification. And I'm going to tell you all this, and then I'm going to say to you, next year, or in 2019, all of the accounting rules change, so this is going to get muddled up a little bit. So maybe we can have a conversation in a couple years. But this is how it is currently. These are the rules according to FASB, which is the Financial Accounting Standards Board right now. Okay, so that was the balance sheet. Any questions that you have on that piece? So that is what you owe, what you own, and then the difference between the two. Pretty straightforward.
Hey, Susan.
Yes.
Tom here. I'm just going to pitch in one on those, the retained earnings. Help me, and the other term for that might be your margin for the year, correct?
Yeah, your bottom line. So that
Right.
your operating, or actually your consolidated income actually flows to that retained earnings piece. So
Okay.
that's the earnings of the organization flow into that retained, or I call it retained earnings because in for-profit world it is called retained earnings. Yeah.
Okay.
Makes sense? Okay. We're going to move on to the second piece of a financial statement, which is the statement of activities, or that's where your P&L statement, they sometimes refer to as a P&L or your financial statement. And this measures your performance through a stated period. So many times at the header, you'll see statement of activities for the period ended, in this case, September 30th, 2017. So that'd be for the first 3 months or the first quarter of a fiscal year. Or at the end of the year, what you typically see is statement of activities for the year ended, in this case, June 30th, 2018. So it's a measurement through a period of time. And again, very straightforward, revenue and expense. And on the revenue side, again, you've got those same 3 buckets. You've got revenue on the operations side. You've got revenue coming in that is temporarily restricted. And again, we talked about that being some gifts perhaps to build a building. Perhaps it's your market adjustment on investments. And then you could have revenue coming in to fund your endowment or your permanently restricted net assets. Okay, so here's another busy one. We've got some red going on, but these are the areas these are the big pieces to watch. So on the statement of activities in terms of revenue, and the bigger pieces are the ones that are in red. So obviously your gross tuition is very, very dependent on enrollment and demographics. And the next couple of slides, we're going to talk through that so you can actually visually see. I've got some graphics here. That gross tuition, of course, is offset by financial aid pressures. And you're going to see again in a couple of slides a graph on that, on the studies that have been done over the past few years. That unfunded piece has risen over time, and you'll see that. The other piece that's important, again, for those traditional campuses that have residence halls and revenue in terms of room and board revenue, camps and conferences you may have on your campus live in that auxiliary revenue bucket. You'll have endowment support, and then you have private and gifts and grants. And I've got that in red too, because that's really much very dependent on whether or not you're in a fundraising campaign. Again, particularly for small privates. Except that what I'll say here is I think fundraising campaigns, you're always in a campaign, it seems to be. But at Valpo, I'll just lift up an example, we're in the middle of a $250 million fundraising campaign that's focused primarily on endowment. So if you're focused on endowment, that's typically where you're going to see all the revenue come in, right? You're not going to see revenue coming in to build buildings. You're not going to see as much revenue coming in maybe for some of those other temporarily restricted initiatives. So you just need to be cognizant of what those fundraising goals are and what the focus is as you review your financial statement. So the watch here is declining revenue trends without explanation. Many of us have declining revenue trends, and we're going to walk through those, actually, the reasons why, on the next couple of slides here. So U.S. demographics are definitely driving higher ed revenues, or driving them down. After about 15 years of consistent growth, we're currently in a decade of declining number of high school graduates. So that's definitely increasing competition for students, particularly in the Midwest and the Northeast. There's going to be an increase again in 2025, but that's quite a few years away. The Southeast and Southwest states will experience, or are experiencing, the greatest growth over this decade in the coming years, and specifically California, Texas, and Florida are projected to have significant increases in enrollment. And some of this is due to the increased number of Hispanic students and Asian Pacific Islander students. So that's very much driving those enrollment in those southern states. But here's the graphic just to show you what I just explained to you. So again, this is over time. You can see since 1995, 2005, 2010, a really, really nice slope up in the number of students, private high school students and public high school students. And now you see in that projected area, that darker line, you can see that flattening between 2010, 2020, 2022 in there. And then, as I said earlier, a little blip up in 2025, and then a steep fall off again, and all due to the demographics in the United States. Some institutions, when I talk to my colleagues, about what are you doing, you're going to see, I'm going to have some graphics on the pressures on that discount rate. Some institutions are looking to increase their international enrollment population, whether it's in their undergraduate or graduate programs as a strategy, but that has its pitfalls as well. Here's the slide on the rising discount rates. This is from the NACUBO tuition discounting study. This is a study that's obviously been going on for many years, sponsored by NACUBO. You can see that top blue line is first-time, full-time freshman students, currently approaching 50%. And I can tell you on our campus, our first-time freshmen are well above 50% at this point in time. So really, really stiff competition for our students is impacting that discount rate. The red line is a blended rate. So this would have freshmen, sophomores, juniors, and seniors in that rate. And obviously it lags because those prior years came in at a lower rate. Lots of competition. So that was the revenue side. On the expense side, compensation is the big deal, right? So when I'm talking about compensation, I'm talking about salaries and benefits. Represents about 60 to 70% of total expense depending on your campus. But this is why it's so hard whenever you have really, serious conversations about budget reductions. It's not easy because you can't, decreasing travel typically doesn't work for long. You can't decrease, entertainment much. The big dollars are in the compensation line item, and that's why budget decisions are really so hard. In terms of benefits, about 30%, it represents about 30% of your salary typically. And I've got the red there for watching the healthcare costs. I know here on our campus, we're continually looking at opportunities to hold the line on healthcare costs. We've got a a free clinic that we introduced into the system that's helping us, but we continue to see some really high dollar claims come through each year, and so it really is a challenge. The bigger expense line items would be those facilities and utilities. Again, this is a traditional campus with lots of bricks and mortar. You have repair and replacement considerations, capacity studies. I have a note there about those because sometimes we think we don't have enough room, and I would venture to guess that if you actually did a capacity and space study, you would find that you have all kinds of room. The other piece of that would be even a study in terms of when do you have your classes? Are all classes Monday through Thursday, or are you really using Fridays? And whenever we talk to our board about this, I'll say, well, we remember when we had to go to class on Saturday, right? So lots of considerations there in terms of space usage. A note there on utility contracts. In our area, we've received several rate hikes for our gas and electric and even our water, but have been really diligent about entering into some purchasing contracts, particularly as they relate to gas futures, so that we can sort of hold the line, or at least take some of that volatility out of the market that we get when we contract directly with our utility provider. Just a word about depreciation, just a reminder, it's a non-cash item. So when you see depreciation on a financial statement, that's not, we wrote a check for depreciation. Depreciation is really a methodology to meet this matching principle that we talk about in accounting, where you're matching the use of that asset or the expense of that asset over its useful life when it's generating revenue. So that's all it is. It's a matching principle. On our campus, we talk a lot about this term EBITDA, and that's, I should have wrote this out, that's earnings before interest, taxes, depreciation, and amortization. And we do that on our campus for a really good reason, and that is because we've been making some very strategic investments in our capital assets. And when you do that, that drives that depreciation expense upwards, right? And that sometimes, again in our case, will drive your interest expense upwards. So that EBITDA measure is just a really good measure of true operating performance, and I've written it here, outside of any decisions you make regarding your capital investments or your financing decisions. So this is the true operations of the organization. And then the note about watching trends over time. Again, and I talked about regarding whatever your strategy is in terms of investment or not, that's going to make that depreciation number fluctuate. Depreciation is many times, or most times, the new projects are depreciated over a longer period of time, sometimes 50 years, sometimes more. I read a financial statement the other day where 70 years was being used. The smaller I'm thinking about software, technology related sorts of things, really you can't depreciate them over a very long period of time because just the very rapidly changing nature of those sorts of investments. And then just an add-on here. So the statement of financial position and your profit and loss statement are the two major pieces of the financial statement. They tell you the most information, but don't discount these two. I'm just going to spend a little bit of time on, and that's the statement of cash flows and the footnotes. And when I teach, I always tell my students, because it depends who you've got in your class, right? Sometimes I've had classes where I've had arts and entertainment students who are very focused on their arts and entertainment and have never seen a financial statement. And they were a little bit overwhelmed when they take a look at a financial statement. And just don't be afraid of them. They're just a bunch of numbers and they tell a story, right? And the really good details regarding that story are actually in the footnotes. So there's a lot of words in the footnotes, but if you take the time to go through them, they give you a lot of information that isn't necessarily apparent on the face of the first two statements. The statement of cash flows very simply gives you the sources and uses of cash, whether you're generating cash through operations or using cash, whether you're borrowing money or if you're paying back money. All of that is on that statement of cash flows. And then the footnote disclosures, here are just a few examples. I think we've got about 17 to 20 footnotes on our current set of financial statements. Each one addresses a different topic, but it starts out with a description of the institution, the accounting policies that are used, really detailed endowment investment information. There are requirements in those regards. Long-term debt details, it'll tell you, typically will tell you how many times you've borrowed, what year you borrowed, how much you owe on each of those borrowings. And my favorite part, I always like flip to the back because that's where you see the lawsuits. And typically there's a general statement that says we are, in the ordinary course of business, we have lawsuits, but nothing that rises to the extent that it is material in nature. And then subsequent events. What is meant by that is the auditors are typically on your campus through a certain date, at which time they issue your report. But then they always do a check back in with us and say, all right, are there any subsequent events of which we need to disclose that we need to be aware? We had actually one this year, and that was related to our debt. We priced debt in the middle of June, and then we didn't close on that debt until July 12th. So because that crossed over at the end of our fiscal year, we had to disclose that in a subsequent event. All right, so that was the financial statements themselves. So any questions you thought of as I was going through that piece? All clear?
Yes. This is Kathy Thunheim from Gustavus. Thank you for your information. This is just really interesting. And the one question that kept crossing my mind, and it seems to me you mentioned it or I saw it somewhere, is the 990. Are you going to talk about that a little bit more, or should I save that question for the end?
That's a perfect segue, and we're going to talk about that in this next section.
Wow. Okay,
Yay.
I got lucky. Keep going then. Thank you.
Okay.
Hey, Susan,
Yes.
Tom again, not to be too much of a geek, but this question about the impact of our discount rate on the institution is profound.
Yeah, it is.
And one of the things I've always argued for is there's sort of a trade-off there. I mean, so it's like I can't reduce my discount rate because I can't get students.
Yes. Let's talk about that a little bit. I think it's worth spending a little more time on that, Tom. I really do, particularly since you raised it, because I've got a great example, and I'm very happy to share it about Valpo that talks specifically to that point. And that is, so last year for fiscal year 17, we increased our discount rate a little bit. We got $90 less per student, per freshman student. But the flip side of that is, on an aggregate basis, we enrolled 120 more students than we did the prior year. All right, so that's for fiscal year 17. For this year, we pulled back on the discount rate just a little bit because it's just such a balance. Actually, well, we did increase probably over $600 per freshman student, but we lost 40 students, right? We ended up not enrolling quite as many students as we did last year. So that's just an example of it's just such tricky stuff. We're a member of a group, it's called the New American Colleges and Universities. We do a study every year on just this very topic, and we've got some great graphics that see this play out time and time again. Sometimes there'll be cases where a new enrollment manager comes in and says, I can pull your discount rate down, and they do, and their enrollment just drops right off. And you see that play out time and time again. Some institutions sometimes it's location. So one of the institutions that's in our group is in a really popular location, and they defy everybody else in the group in terms of they've been able to gradually pull back on that discount rate year after year and are just doing really, really well. So it's tricky stuff. One more thing I'll say about that, and I meant to talk about, was you saw there was a piece, financial aid, of course, can be funded or unfunded. It's the unfunded piece that we're really worried about. The unfunded piece is taking dollars right out of your budget that could be spent elsewhere. The funded piece actually has a piece of income that's flowing in to support that funded scholarship. And so when I shared earlier that Valpo's campaign is focused on fundraising for endowment, it's really primarily focused on fundraising for endowment for scholarships. So.
Susan, what's interesting, you do a good job. Theoretically, there are ways you could reduce your discount rate, lose students, but still make more money. But it's such a nuanced, it's like taking a little vernier, a little tweak on it.
Yes, it could be half of a percentage point.
Right.
Does it? Yeah, yeah.
And one other one, just, and I think folks hear about this term depreciation.
Yeah.
And here's how I thought about it, Susan. So you can help me. In one sense, if you put depreciation, if you fund depreciation, that is, there is revenue in your revenue and expense budget, and if depreciation's on the expense side, and you fund that depreciation with revenue, that almost ends up being a savings account, sort of.
It does, yeah, kind of, sort of.
Kind of, sort of.
Yeah. I call a little bit of a cushion because it does, you're absolutely right. It helps I'll tell you what, Moody's will always ask institutions, are you funding depreciation? Are you including depreciation in your budget? Because they're looking for that. They're looking for that more conservative approach to your budget process. Because, I mean, we all know that there are surprises typically throughout the year, at least there have been in the 20 years I've been at Valpo. There's always some sort of surprise. Many times they're great surprises, right? But sometimes not so much. So, yeah.
Well, and I think I've talked to the fellows before about these 20 indicators. But to me, a warning sign in an institution is, I don't have the revenue to fund depreciation, therefore I'm not going to fund it. And now, warning, whoop, whoop, whoop.
That is a warning. That is a warning. That absolutely is a warning. Yep. Really good indicator. Okay. All right, we'll move on. We can come back to anything you all want, but because Kathy asked, I think we'll talk about the IRS Form 990. We're going to talk about that in a few other things in this section. So the first thing here you see are some examples of external reporting requirements. One of those being the IRS Form 990. Nonprofits do not have to pay tax, but they sure have to file a lot of information to the IRS. And what they're really looking for is ensuring that the institution is truly meeting not meeting its mission, but performing as a nonprofit. So they ask all kinds of questions about governance, about structure, and how you do things. We're going to I have a whole another slide on the 990, so we'll talk about that one in a minute a little bit more, so I don't go from memory. But you can see pretty much all nonprofit 990s on GuideStar. If you're not aware of that, that's I've put the website there, guidestar.org. The challenge with that, it's usually a couple years old, so they go out and they grab the 990s and they post those, and so they're out there for everyone to see. But it's a good resource. IPEDS, you all are probably aware of, that integrated post-secondary education data system, 12 interrelated surveys. What I like about using IPEDS data whenever we're doing benchmark reporting is there are common definitions that are pretty straightforward in terms of what's included, what's excluded from each definition. But what I will say here, again, referring to my interaction with my NAC and U colleagues, we do a IPED study every year too, where we compare our institutions in all of the categories. And what we've found that there are institutional differences. So while the definitions are common, and what do I mean by that? I'm specifically thinking about some of our institutions are Division I athletics. Some of them are Division III. There's a difference in cost structure there. There's also one of the other big differences are if you outsource your dining or your facilities, sometimes that skew the data a little bit too. So whenever you're comparing yourself to other institutions, I guess my point is make sure that you understand what their structure is and what some of their institutional differences might be before you get too worried about any big differences in what you see. And then EMMA, this is the Electronic Municipal Market Access. This is MSRB. So this is where institutions that have public debt must post their disclosure information every year. And if you want the most up-to-date information on any institution that you know has public debt, this is the place to go. And it's a relatively new electronic website that not a lot of people are really aware of, but it's a great resource if you're looking to grab another institution's financial statement. Typically you not only have to disclose your financial statement, but you also have to require listed disclosures. So again, in Valpo's case, we have to report our enrollment numbers, our application numbers. We need to report where those students are coming from, more detailed information on financial aid. There's a variety of different pieces of information you can get on all those institutions. Okay, so the Form 990, I can actually call up the 990 if you all wanted to look at it, but I did leave the website above, just an example, a PDF there. In terms of the current form, if you go to this philanthropynewyork.org, there's actually an example completed schedule so you can see, but just thought I'd lift up a few key pieces on that 990. First, there's that description of the institution's mission. So remember I said this gets posted on the GuideStar website. So even though this is an IRS form that you're thinking, okay, we just need to get it complete and get it out the door, you really do need to pay attention to what you're putting there because they're likely, you don't know who's going to be looking at that 990 to learn more about your institution. Many times it's a donor or a potential donor that is interested in learning more about your organization. So you need to be really careful about that description. Again, multiple questions regarding disclosures and governance, as these are yes, no, check the box type answers, and you know they're looking for you to put that check in the wrong box so they can ask you a question. Key employee compensation. So there'll be a list of your members of your board of directors. At Valpo, our board of directors are not compensated. But along with those key employees, with the board of directors, you report those key employees. So typically those, you're gonna see your president's compensation, depending on if you're a basketball or a football school, those coaches typically are listed there. They're your highest compensated employees are listed on that form. Program service versus management expenses. There is a section on the 990 where there are sort of three categories that are to be completed. And what folks are looking for there is to ensure that the bulk of your expenditures are going towards your program. So what they want to see is a big percentage in that column versus the other two columns are management or administrative expenses and fundraising expenses. So they're more inclined to the theory is that donors or others are more inclined to support institutions that are supporting their programs in a major way. You also need to include a schedule of contributors for the 990 that goes to the IRS. This is by name. You do not, however, have to supply that information, and that information is not supplied to GuideStar. They do not have a list of your contributors out there. Tax-exempt bond information is out there, is on the 990. And transactions with interested persons. So for example, if you're doing business with a board member, that disclosure is also required on the 990. So those are the bigger pieces. Kathy, did you have any specific question that you had in mind in terms of the 990?
I think you covered it. So
Oh, good.
I'll just share with you that we have three distinguished professors here, and of course the faculty figured out that their pay, because their key employee compensation got out, and it created quite a ruckus here. And I just realized that people don't really understand what the 990 is, and so we needed to do a little education, and it's all good. But anyway, thank you. You've covered it.
Yeah. That's probably the most sensitive area, I'd say, of the 990. The contributors could be sensitive, but there are safeguards in place on that one. But yeah, you're right. The key employee compensation is. So we had an example even a few years back when we had a retiring president that actually had a deferred revenue or deferred compensation. So, and this, he was a beloved president that refused salary increases year over year. I mean, just refused them because, he felt he was compensated appropriately, and that's how he chose to address that. But then the year that he had the deferred piece kicked in, we never had any pushback on that, but that was something that was sort of on our radar screen, and we were prepared to address if it came to light. So, yeah.
Good example. Thank you.
Yeah. All right. Just some notes here on performance trends and benchmark information. And of course, those of you that already work in the finance space know that you can't just look at a snapshot of a institution's position in time. You have to compare that year over year to get that trend data. And also compare yourself with your peers or like institutions. So you could be way out, thinking you're doing great, but then line yourself up with another institution and then maybe not so much. So important to do both of those things. We do that every October at Valpo. And all of the committees of our board require us to do this. So not just the Finance and Administration Committee, but also the Academic and Student Affairs Committee, our Marketing Committee, all of the committees look at benchmark and peer data during our October meeting. We're going to drill down in the next couple slides on the next two topics, the Composite Financial Index and the Department of Education financial score. Again, some of you may be more familiar with this than others. And then just a note on ratio analysis, and a kudos again to the book. If you're interested in financial analysis and ratio analysis, they did a nice job, I think, of explaining in layman's terms what they mean. But for me, the key thing is they serve as a warning sign. They can be red flags. And so for me, that's why the ratio information is important. They can give you some trend data and let you know where your problematic areas are. So I said we're going to drill down on the CFI. I don't know how many of you are familiar with this, or if you've heard of it, or if your institutions use this, but our auditors typically even calculate this for us in connection with our audit report each year and report this out to our audit committee. So the CFI is, as you can see, a composite of 4 ratios. The primary reserve, which measures financial flexibility, net income on operating performance, return on assets, which is overall performance, and then viability, which is your ability to cover debt. So they take those 4 ratios and give you a composite financial score. And you can see here, you can score on a scale of -1 to 10. And this graphic I like because it just gives you a sense of where, say you score a 3, you're able to, according to the score anyway, able to direct your institutional resources to allow transformation. Whereas if you are on the other side of that 3, you're spending a lot of time thinking, if you're in the -1 to 0 category, about the viability of the organization, or re-engineering. And then as you move to the right on that screen, you can see you're getting a little stronger financial position. We've been as high as a 7. We're not a 7 today at Valpo, but we'll get back there at someday. But again, just gives you an idea of where you kind of fall out in a composite index. The one other thing I know our auditors always caution us on is to be cautious not to look at 1-year score, but to take that over 3 years, and because a lot of this has to do with market performance that's impacting your score. Then the DOE, Department of Education Financial Responsibility Score, and they actually calculate this score based on the annual financial statements that you submit to them, because you are, and I'm assuming most of you are accepting federal financial aid from the government. So this score was designed to measure fiscal stability of colleges. There's lots of controversy about how they do that. They actually publish those institutions that are in that -1, or I know definitely -1. I'm not sure how high they go up there. I'm just glad I'm not on that published list right now. But this one incorporates three ratios, 3 of the 4 that actually are incorporated in the CFI index. But again, I've highlighted in red that score greater or equal to 1.5 indicates the institution is financially responsible. So this score is -1 to a 3. If you're a 1.5 or above, you're in decent shape, and you have no worries as it relates to the Department of Education. If you fall below that, then the Department of Education requires some additional monitoring.
Oh, so can I ask a question?
Yes,
Do
absolutely.
you happen to know across our 26 schools, how many of our Lutheran higher education schools are above 1.5, greater than or equal to 1.5?
Boy, I don't know, but I'd
We
love
don't
to.
need to know names. I'm just curious.
That'd be a great survey to do, don't you think?
Susan, Tom,
Yes. Oh.
yeah, it's more than 3/4 or above 1.5.
Good. Thank you.
Oh, you do know that. Good.
But the ones that are below are really below. And we won't name names on institutions, but you can probably think of a few that are really struggling deeply.
Thank you.
Yeah, and Susan, the other thing, I don't know but CIC also looks across all institutions. Kathy, getting to your point of view, first of all, you'll see the list of folks that are in the penalty box with DOE. That's usually published in the Chronicle.
Yes.
So that list will be, you can go to the Chronicle for Higher Ed and see that list. It's not below, if I remember, Susan, it's not below 1.5, it's below 0, the ones that are in the real penalty.
That's what I was thinking, but I wasn't certain.
Yeah. And then, and then the other place that this information is aggregated that's really, I think, useful is CIC. They'll look at your indicators and then map you against peer institutions and all the institutions in CIC. It can be real helpful.
Yeah. Very good. Great points. Good questions. All right. I want you to put, I think Tom's going to supply you a copy of this after I'm done. And I probably should have acknowledged that many of these ideas actually came from an AGB, Association of Governing Board. They're not word for word, they're my own words, but webinar. They're really big in this space in terms of some of these cultural challenges or structural challenges that higher ed institutions are in the midst of currently. They had a great webinar about a month ago. If you follow them and you get an invite to join one, I highly recommend that you do that. There are going to be some slides that promote their services. They have some consulting arm, but there's a lot of good data there if you get an opportunity to listen in. But what I thought I'd lift up is maybe some of their key takeaways for me when I listened in. Overall, the very first slide talks about higher education will not be immune to sector failure. So they talked about other industries where there's been a failure. Think of the record industry as we knew it when we were, or at least when I was growing up. You know, something simple as that. In other sectors that they fail because of a variety of reasons. Changes in demographics, you know, is a challenge for us. And affordability, college affordability pressures that we hear all the time on the need to ensure that higher ed is affordable for our students. So lots of different things. One of the things they talked about, one of my favorite slides, was actually a comparison of how institutions of higher education have been structured and have operated traditionally, as opposed to their view how we need to change going forward. And they talk about that, really, and it's true, we think about it, the natural rhythm of the higher ed cycle is slow. And if you've worked outside of higher ed, you know how slow it is. And it can be very challenging when you first step on campus. But it has to do, for a lot of good reasons, shared governance. While, sometimes I'm like, oh my gosh, we have to run this by one more committee, but it keeps us from making those rash decisions and gets some really good and important ideas in the discussion before decisions are made. But at the same time, it's really slow. Our academic year runs a year. So, we've got all those constraints. We have, commitments to our faculty and staff. We think about tenure and what that means and how we need to honor that and for good reasons. But again, that slows down any sort of cycle or of change you might be thinking through. And then, even the endowment, when we think about restrictions, we have donor restrictions that we certainly must honor there. And then even we think about investing that endowment into perpetuity, which is forever, right? So we're really long-term institutions that have a far horizon. With that said, the overall key takeaway, again, for me from this webinar I listened to, was we need a bias towards action in challenging times. So what does that mean? We need to be able to respond in a rapidly changing environment. They talked about revenue diversification. When we talk about it on our campus, we think about it in a variety of ways. You can think about it as those buckets that we talked about earlier. We've got net tuition and fees. You've got auxiliary revenue, campus and conferences, room and board. You've got private gifts and grants. We've got athletics income. We think about those things. We think about it in a couple different ways. We're thinking, and this will be unique to every campus, you may have opportunities to develop property in a way that will annuitize the use of land over time. There's those opportunities. But the AGB webinar actually spoke about how we need to diversify our academic revenue streams. And by that, they lifted up the need to focus on alternate program delivery methods. So the online, they're talking online. They talked about the number of individuals in the United States that have completed a degree partially, and how that degree completion avenue should be considered. And of course, they talked about the growth in the Hispanic population that we talked about earlier, in terms of, those are areas where you need to turn your attention. When I talk about alternate program delivery, anytime I talk about that to anybody, I lift up my own daughter, so bear with me for a minute. But just for me, it really hits home, and here's why. She attended she had a traditional undergraduate experience, graduated with a bachelor's. She was an educator. She worked in the classroom, elementary classroom, for about 4 or 5 years. And then she started to teach online. And I was like, what do you mean you're teaching online? How do you even do that? How does one even go about that? And when I say teaching online, I'm talking about teaching elementary students, 5th graders, 4th graders, 3rd graders online. And typically these students, she's in Florida, and Florida requires each school system, to offer an online education opportunity. And these are typically students that are either homebound or homeschooled. And so what she really does, while she does work with the students, she's also coaching the parents in many cases, right? So fast forward, during this time, she's also received her master's degree from the University of Alabama, and she's completing her doctorate in education online with Florida State. All of these online, her master's degree, her doctorate degree. She's in the first cohort of that doctorate degree at Florida State. But, you know, it really is a convenience thing for her. And now she's an online principal living in Florida for a school in Alabama. So it's just, it's a different world. I guess that's my message there. And then the final point, you know, for those institutions, and Tom, for those that, you know, maybe you were referring to, or the CIC, the list of the DOE institutions, you know, some we're likely to see more partnerships, whether they're contractual in terms of delivery of services, or mergers, or outright acquisitions. There's a lot of chatter about that. We haven't seen a lot of it, but there's a lot of chatter like that going on, and AGB absolutely feels like that's going to be the way of the future. One caution there is, and this is actually a question that came forward during the webinar. Someone said, well, what if your institution's really not wired to change, A, and B, not willing to change? Then what, right? So, and this was specifically related to the conversation about diversification of programs, but also about mergers. And they said, well, what you need to start thinking about is, what do you look like today, and where do you think you're going to look like in 5 years, and work back in a timeline to talk about a merger or acquisition or partnership strategy. Because by the time you let those 5 years play out, you're not going to be worth what you are now, right? And you're not going to be as attracted to other institutions as you are now. So they just they lifted that up as a piece of advice. All right. This is my final slide, folks. So I think we're doing okay on time almost. Just a few words about the proposed tax reform that the House has proposed, ever changing even probably as we're sitting here. Actually, that first bullet point that I typed up last week read a little differently, but there is a proposed 1.4% tax on the net investment income of endowments, specifically endowments that are greater than $250,000 per student. Last week, that was $100,000 per student. So they've pushed that up a little bit. That, to me, that's not much of a surprise, because there's been a lot of chatter about that over the past years. The next bullet, elimination of certain tax credits for higher education expense and deductions for student loans, employer-provided education assistance. This will impact our students. I read an article that with all of these, we'll get to the end in a minute, but so I don't forget, if all of these were to be put into play, this will cost our students about $65 billion fiscal year 18 through fiscal year 23, which is just crazy. Third bullet, this is a big one on our campus. I had to give a presentation a couple days ago, and we covered these exact same points. And we do have tuition remission exchange on our campus for our employees and dependents. That becomes a taxable event in this House bill proposal. Yeah. And y'all know that's for us, that's a big attraction. That sets us apart in our community in terms of being able to attract folks to work at Valpo. Fourth one is near and dear to my heart, because we're thinking of refunding a 2010 bond issuance. But this proposed bill eliminates tax-exempt bonds and the current refunding of existing bonds. So all of those tax-exempt bonds that we have on our campus will no longer be able to do in the future, which is crazy. It's increased cost of borrowing for all of those capital projects, which eventually gets passed on to our students. And then finally, just a little note on changes in personal deductions, and specifically the standard deduction is proposed to be doubled. So the thought there is folks would be less inclined to itemize deduction, and then maybe less inclined towards charitable giving. So, who knows how that'll play out? Who knows if any of this will move forward? I've heard the Senate bill does not have the bonds. They do not have the elimination of the tax-exempt private activity bonds. So stay tuned. And again, the outlook for Moody's on this, if these go into play, if these come to fruition, is a credit negative for all of higher ed because of the financial impact.
So, Susan, this is Mary Ann, and
Yes.
I would encourage all of us to think back to David Warren, the head of NICU, and his presentation this summer. Because this is the next step in this. And I mean, that probably sounds like a politically charged remark, but it is part of the reality for higher education and the dismantling of the structure. So I just want to point that out. This is serious. This is serious business for all of us in business.
Marianne, you cut out at just the wrong time. Dismantling of what?
It's the dismantling of the higher educational structures that have been put in place over a number of years in this country. And this is really a helpful list. Susan, thank you so much. I mean, there's so much about this presentation that's so good, but this is really concerning. And this will have, when you put this together with the other disruptive changes in drop of available students and our discounting rate, when you put all of those things together, this is a disruptive environment.
Yep.
And I think it really, no matter where you land politically, it behooves all of us to be aware of this and cognizant of it.
Yeah. I agree, Marianne, and I meant to say when I introduced this is not a political statement of any kind. It's just a watch this, folks. Just watch this, because this is serious stuff here. Yeah.
Susan, thanks, Bundle. Do you have a few minutes that you can, if you can switch your screen back?
Oh yeah. I have to make you the host, right?
Well, I'll make me the host. How's that sound?
Okay. That sounds
I think
good.
I can do that. I'm not sure anymore.
Well, let's see.
Yeah. But do you have a few minutes for a couple questions?
Oh, absolutely. Did you take it back? Did you take control
I'm
back?
working on it.
Oh. Okay.
I got to figure this out. So, but if you have a question, come on up and come on and raise it, please.
Yeah.
Susan, this is Sonia at Augsburg University. I have a question.
Yes.
Thank you for all of this, and especially that last slide. It just makes me wonder, why are we going about our daily life on our campuses and not completely freaking out as a, as a whole right now? I mean, to sort of say, take a time out, we're going to have an entire all-staff student body meeting and spend an hour on this.
Yeah. Yeah, we, again, I shared this with, we have a university leadership forum on our campus, and it was jam-packed this time for a variety of reasons. You never know what is going to bring people out. They send the agenda out and then people show up. But I presented this, and similar to you, they're like, what can we do? I mean, what can we even do? And of course, we have to be cautious about lobbying, but our president said, folks, contact your congressman. You just got to do that. You have to be active. You have to make your voice known. So, I mean, in terms of this specifically, but you're right, it can be overwhelming. And I just go back to that first quote, and sometimes you just got to keep going back to that first quote about how important your work is, because even though you might not see a student, or at least I don't see a student all day long, you're helping make it happen. And we just have to continue to be more innovative. You'll see that word over and over and over again in all higher ed stuff. What does that mean? I think we're going to have some very interesting, Tom has control now, I'm not doing that. Some very, very interesting years ahead of us. It can be very overwhelming. Even on our campus, sometimes I just have to go outside of my office, look around campus, and or talk with some students, just to get that grounded feeling. But we cannot be inactive on these things because they are threats. It is a disruptive, I think, Marianne, you said it best, it's a very disruptive environment. No silver bullets, unfortunately.
Thank you.
Yeah. Can I ask, do you know if any of your campuses are thinking about doing things differently, or anything really wonderful? And Tom's laughing. He's like, I'm looking for the silver bullet.
Well, I'm not sure there is one, Susan, but I know within this group there are people doing amazing things. And you know, on the Concordia side, Concordia Portland is, I mean, reimagining the entire way it lives its life. And so there's all those sorts of things. I know other institutions, Sonia, your institution now is doing some amazing things in how you approach your community. And I think, Susan, that's part of it. It's really, we have to understand who our communities are and how we serve them. And then that helps us then say, what are the innovative things we can go out there and do?
Yeah, that's key. I mean, we think about our summer programs too, and I think you hit on it. It's like so many times we offer programs to our students because they're the programs we think they want, or they're the programs maybe our faculty would like to teach, but it's not necessarily what's going to drive revenue. I mean, it's very, very challenging times. Yeah.
I think one of the things that I'm finding really interesting as we're going through this what I think is really becoming a very exciting experience at Concordia. Oftentimes, and most of us can look back on our career and our roles and say that we've done research on, well, what are other institutions doing? Who has been successful at this? And the fact is, there's no playbook. I mean, we are inventing this. It's going to be trial and error, and it can be really exciting. I think we have to have a level of risk tolerance to do it, and realize, the downside is to not do anything. We're going to take risks. We're going to try some things, and we may fail a little bit. But if we don't do something, we know what that's going to end up like. So,
yep. Great comment.
This is Kathy at Gustavus, and all I can think of Thrivent Fellows. Has there ever been, a more important time for leadership, right? Because my CFO stands up in front of the faculty. They don't want to add any graduate programs. They don't want to do anything different. And if the leader can't make essentially the business case for this, there's, we're going to die, or we're going to have to merge, right? So, I mean, it is really compelling, and I think articulating the case for it is really what's needed and hard to do. So, good for you, Bobby.
And Kathy, I would say both great points. We need creative leadership instead of reactive leadership. So those of you who've been working with me on coaching, we talk about this a lot. What is the creative leadership, and where does that flow from? That's that inside out model. It's not solution, problem, solution, problem, solution, but it's how do you get, and Susan, you use that word, we're talking about innovation all the time.
All the time.
Right? That you cannot get to innovation by reactive leadership. Okay. And so all this work that you're doing is so important. It gives me hope to see all of you sitting here and how hard you're working on this program, and also in the places where you show up every day. So just a fantastic presentation. Thank you so much, Susan.
You're welcome.
Yeah, and Tom here, Susan needs to go to lunch. she's in a meeting in the East Coast. So I will email the slide, Susan's bio, and again, that reference to financial intelligence, so everybody has it. I know I had that summer retreat. Susan, thank you.
Yeah, thank you for your attention.
An incredible presentation. Blessings. Have a great time in Charleston, and I'll see you when you get back to campus.
All right, good deal. Thank you, everybody.
Thank you very much.
Bye-bye. Bye-bye. Off here.